Welcome back to our second session on bad debt and provision for bad debt. I hope you liked the last session where we discussed the principles of bad debt and provision for bad debt. Now we're gonna go into the principles further, but let's just recap what we discussed. First, we established what is bad debt. We said bad debt is where we sold to a customer on credit. It is important. They receive the goods and for some reason they're not able to pay. We've documented this information in a ledger. We now need to go to the ledger because we have it on our books that they will pay us, and we need to remove that debt and assume that debt ourselves, where the business is going to be absorbing it. And we're going to actually demonstrate how this occurs. We also have the principle of provision for bad debt. Now, provision for bad debt looks at estimating or preparing for the possibility that some of the debt that we have, which customers owe us, we may never receive. And so we make an allowance for that via the principle of provision for bad debt. And we also spoke about the aging report, where we have a rundown of all the various customers that owe us at different months for a period, and then we attach percentages to that to it, and therefore we are able to now kind of estimate what proportion of the debt we may not receive, and then we can increase or decrease it accordingly. So we're going to tie in those principles now that you have a background in terms of the idea. Now let's have a look at this example. Let's say we are going to use 5% generally. We're going to use a solid 5% on the aggregate debt yet to be paid. So our sales, and now the aggregate debt yet to be paid is normally in accounts receivable. So our accounts receivable control will actually give us the aggregate debt yet to be paid. Now, let's say we're going to use a solid figure. Instead of being a bit scientific and having a breakdown of several percentages, let's use one solid percent and then calculate what we estimate the debt that we will not receive. So that would be 5% of 50,000, and 5% of 50,000 is 2,500. So we now realize that we have to prepare for the possibility that 2,500 of the 50,000 we will not receive. So again, we know the allowance account is a credit account, so we go on the credit side, and then we go on the debit side of the increase because it's the original or the very beginning, and then we make the debit, okay? Because we know if it's an increase, an expense accounts are debit account. So we go on the opposite side. So we say the 31st of March 2021, the allowance, provision for bad debt, I have to abbreviate that, 2,500, and then the allowance account, there we have the opposite, which is the increase in provision for bad debt, 2,500 on the credit side. And then we can balance those accounts. The allowance account is normally we carry the balance forward consistently because of the fact that we may have to adjust it in the future. While the increase account, it will be write off in the income statement. Now, initially we'll go to the trial balance, but then moves to the income statement as an expense. All right, so that's the main idea. So that's why on the credit side, we have it saying it goes to the P&L as an expense. Now let's look at another example. Now, let's say we have a situation where instead of 5%, we're now going to estimate 2% because customers have been paying us regularly. So we say, okay, fine, let's adjust the percentage and don't provide for a huge amount. Okay, so let's say we have 40,000 in sales in the accounts receivable ledger, and we're going to find 2% of that. So 2% of that works out to be 800. Now, this is how the principle works. Because we had a situation where we provided for 2,500 before, we cannot bring that figure forward. So we now need to adjust that figure. So we go on the opposite side now because it's a reduction. An increase will always be on it's an expense side, but because we have a reduction, we have to do the opposite of expense, and the opposite of expense is income. So we go on the opposite side now, and we need to make an adjustment. The historical figure that is coming from the previous accounting period was 2,500. And so 2,500 at this point is inaccurate, because we now realize that the total provision that we need to make is 800. And so we need to adjust it by 800. And so therefore, if we're reducing it and adjusting it by 800, then the figures has to change accordingly. Okay, so here we're going to demonstrate the idea. Now let's look at this concept as well. Okay, we can also consider it in terms of zero accounting software. Now, I was trying to get an example that actually really fits the principle, but let's actually look at this one. Okay, so in terms of zero accounting software, again, once you establish that the debt is bad, you need to then create a ledger of that, make an adjustment in the various accounts, writing it off as an expense. So that's the main idea. All right, so you go to the bad debt account, actual account that you know is bad, and then you write it off. That's the best way to do it. Okay, now again, you can create a bad debt account. You could also create a provision for bad debt account where you actually provide or prepare for the possibility that the expense, or rather the customers that we intend to receive money from, we may not receive from. So we actually could prepare for it and create an account to actually reflect the allowance for bad debt. Okay, so let's move on to the definition of provision for bad debt. Now, provision for bad debt is the estimated percentage of the total doubtful debts that needs to be written off during the year. It is nothing but a loss to the company which needs to be charged to the profit and loss account in the form of provision. It is done on the reason that an amount of loss is impossible to ascertain until it's proven as bad. Okay, so once it's proven as bad, then you can make the adjustment accordingly. But this is more of a cat and mouse kind of situation, because we do not know what the future holds, but we're kind of preparing for the possibility that something will go bad and that this debt will go bad. So that's the main idea here. All right. Okay, now let's look at the impact on the income statement. So we've mentioned the fact that if a customer does not pay us, we assume it to be bad. Now, when we assume it to be bad and we create a bad debt account, that goes to the trial balance and eventually to the income statement as an expense. So we would put among our various expenses, and we know the main thing is that the income statement is divided into two categories, the income and then the expense. So we would put this as an expense, and here the expense is 5,000. Now, when we also have a situation where we have an increase in provision, which means we estimate that a proportion of the debt we will not receive as well, here we would put it as an expense as well, increase 2,500. So the aggregate in this example is a bad debt of 5,000, a rent of 200,000, and the increase of 2,500. Altogether, that's 207,500 minus from the 2 million in gross profit. Now, we could also have a situation where we consider the impact on the statement of financial position. So in the statement of financial position, it is 50,000. That is our accounts receivable, and therefore we need to adjust by the 2,500, which we've estimated in terms of the provision for bad debt that we assume we will not receive. So therefore, the adjusted accounts receivable now is 47,500. Okay. We can also, as we mentioned earlier, have a situation where there's a reduction in provision. Okay, and then that reduction in provision, we need to consider it as income. Okay, so reduction in provision here is income in terms of the 800. So this 800 we initially had provided for 2,500, which is the running balance coming from the previous period. But in this situation, we realize that 2% of the current accounts receivable is 800. And so if that's the situation, we have over provided for. So in reality, we actually need to reduce everything by 1,700. Okay, so 1,700 is what we need to reduce it by. And so therefore, we actually need to add the 1,700 back to gross profit as income. And so that's the main principle here. So this principle could be a bit tricky because the current provision for the period is 800. And it's 800 because it's 4%, it's 2% of 40,000. So it's 800. And so because of that, we have to adjust all the figures, and therefore we need to add back 1,700. Okay, and therefore others, which if we are considering a bad debt as well, which is 5,000, and then the rent is 200,000, that's 205,000. We subtract it from the income. In terms of the statement of financial position, we have the 40,000, and then we need to make the adjustment accordingly. Okay, so current provision, as I said before, that is going forward would be the 800, and so 800 would be subtracted from the 40,000. So we need to make an adjustment accordingly. If we were to consider in terms of the impact on Xero accounting software, again, it's categorized in income and expenses, so we can actually consider the income side of it first in terms of adjusting the income. If there is a decrease in provision, we adjust accordingly in terms of the income side. But if there's an increase in provision, we adjust in terms of the expense side. And as you know, in terms of the statement of financial position for Xero accounting software, you go in a current asset and then you adjust the accounts receivable accordingly. I hope you like this. In terms of the principles, we've looked at bad debt. We've looked at examples relating to bad debt. We've looked at provision for bad debt. We've also looked at the impact in terms of Xero accounting software for both. And also we've considered the impact on the statement of financial position. I hope you like this. It's a quite lengthy one, but lots of principles here. If you really want further explanation about this, you can write it in the chat and we can discuss it further. But like, share, subscribe. Thank you.